Have you ever wondered why some people stay rich while others, despite their wealth, find themselves back in the rut? This question sparks the intrigue of our journey today as we delve into the paradox of wealth and investment. We often equate wealth with the accumulation of money. The more cash you have, the wealthier you are, right? Well, not exactly. This is a common misconception, a mirage that often distorts the real picture. You see, wealth isn't just about the money you have, but rather, it's about what you do with it. Take, for instance, the story of a lottery winner. Let's call him John. John, like many others, dreamed of riches and wealth. He bought a lottery ticket, and to his surprise, he won. The sudden influx of money was overwhelming. He bought a mansion, a fancy car, went on luxurious vacations, and before he knew it, his bank account was dwindling. John, despite his initial wealth, found himself back in the rut. He had money, yes, but he lacked something crucial: the knowledge and the tool to preserve and grow his wealth. That tool, my friends, is investment. Investment is the vehicle that drives your money towards growth. It's the seed that, when planted and nurtured, can turn a small saving into a fortune. But like any vehicle, it needs a driver, and like any seed, it needs a gardener. That driver, that gardener is you. Investing isn't just about making more money. It's about strategic planning, understanding the market, and making informed decisions. It's about turning your money into an employee that works for you, generating more income even while you sleep. So, what's the secret to staying rich? It's simple, really. It's not about how much money you have, but rather, how well you manage and invest it. The paradox of wealth and investment lies in understanding this principle. True wealth isn't about how much money you have, but how well you manage and invest it. So how do the rich stay rich? It's simple. They invest, and they do it wisely. Let's delve into the power of informed investment. Imagine for a moment, you're Warren Buffett. Buffett isn't known for being the highest earner year in and year out. Instead, he's known as one of the smartest investors of our time. His secret? Informed investing. Buffett didn't amass his wealth by merely making more money. He did it by investing wisely. He understood that every dollar invested is a seed planted for future wealth. And like any good gardener, he knew that the right conditions and care could turn a single seed into a bountiful harvest. Now you might be thinking, sure, but Warren Buffett is a financial genius. True, but the principles he followed are available to all of us. It all starts with financial education. Financial education is not about getting an MBA or becoming a Wall Street whiz. It's about understanding the basics of investing, the trends in the market, and the forces that drive financial growth. It's about staying informed about the market, the economy, and the broader world. Information is power. The more you know about the market, the better your investment decisions will be. This doesn't mean you need to spend every waking hour glued to the financial news, but it does mean you need to stay informed, understand the risks and rewards, and make decisions based on sound knowledge and understanding. Informed investment also means understanding that not every investment will be a winner. There will be ups and downs, there will be risks, but with knowledge, with information, you can mitigate those risks. You can make decisions that align with your financial goals and your risk tolerance. Informed investment is not about quick wins or getting rich overnight. It's about long-term wealth creation and preservation. It's about making smart decisions today that will pay off in the future. It's about planting those seeds of wealth and nurturing them over time. Informed investment is a powerful tool for wealth creation and preservation. And remember, the journey of 1,000 miles begins with a single step. So take that step today. Start your journey towards informed investing. Because the rich don't just stay rich by chance. They do it through informed, wise investing. But isn't investment risky? Yes, but remember, with great risk comes great reward. This saying isn't just a cliche, it's a fundamental principle of investing. It's all about balancing risk and reward. It's like walking a tightrope. You need to maintain equilibrium to stay on track. Picture a startup investor. They're faced with a new venture, an idea that could revolutionize the market or crash and burn. This investor doesn't shy away from the risk. Instead, they embrace it, understanding that the potential reward could outweigh the risk. They're not just throwing their money into the wind, they're taking a calculated risk. They've done their research, understood the market, and evaluated the potential. And when the startup takes off, their calculated risk reaps a massive reward. Now, does this mean you should throw all your money into every risky venture that comes your way? Absolutely not. Embracing risk doesn't mean being reckless. It means understanding the risk, assessing it, and then making an informed decision. It's about finding the right balance between potential losses and potential gains. So, how do you manage risk? Well, there are a few strategies. One is diversification, spreading your investments across different assets to reduce the risk of losing everything if one investment fails. Another is by setting stop-loss orders, which automatically sell your investment if the price drops to a certain level. But perhaps the most important strategy is understanding your own risk tolerance. Everyone has a different level of comfort when it comes to taking risks. Some people can handle the roller coaster ride of high-risk investments, while others prefer a slow and steady approach. Knowing where you stand on this spectrum can help guide your investment decisions. So yes, investment can be risky. But understanding that risk, managing it, and balancing it with potential rewards is a crucial part of the investment process. It's a game of strategy, not just luck. And the better you understand the rules, the better you'll be at playing the game. Knowing your risk tolerance and managing it effectively is key to successful investment. How do you manage risk in investment? The answer is diversification. Imagine this. An investor, let's call him Joe, puts all his money into a hot tech stock, hoping to ride the wave of its success. And for a while, it works. Joe's investment grows, and he feels like a Wall Street whiz. But then, the unexpected happens. The stock plummets, and Joe loses everything. Why? Because Joe didn't diversify his portfolio. He put all his eggs in one basket, and when that basket tumbled, so did his financial future. Now let's talk about diversification. At its core, diversification is about spreading your investments across various asset classes like stocks, bonds, real estate, and more. It's like a buffet. You don't just load your plate with pasta, you also add some veggies, a little protein, maybe a roll or two. Why is this important? Well, the market is unpredictable. Some sectors may perform well while others lag behind. By diversifying, you're not betting on any single sector's performance. Instead, you're spreading your bets across the board, reducing your risk of major losses. Think of diversification as a form of insurance. It can't prevent a negative event, but it can certainly cushion the blow. If one investment falls, you have others to balance the loss. It's a safety net, a way to protect your wealth from market volatility. But remember, diversification isn't just about quantity. It's also about quality. It's not about owning 100 different stocks, but owning the right ones. The goal is to create a balanced, well-rounded portfolio that can weather the ups and downs of the market. So what's the takeaway? Don't be like Joe. Don't put all your eggs in one basket. Embrace diversification. It's your best defense against the unpredictable nature of the market. Diversification is not just about spreading your investments, it's about securing your wealth. What's the secret to successful investment? Patience and consistency. Just think about it. Have you ever tried to grow a plant? First, you plant the seed, then you water it, and then you wait. You don't pull it out of the ground every other day to check if it's growing. You trust the process, and in time you'll see a sprout, then a stem, and finally, a full-grown plant. Investing works in a similar way. Take the story of Morgan Housel, a renowned investor and financial journalist. He wasn't an overnight success. Rather, he stayed consistent with his investments over the years and achieved immense success. He understood that wealth accumulation is not a sprint but a marathon. It's about endurance, not speed. In the investment world, it's not about timing the market, but time in the market that counts. The longer your money is invested, the more time it has to grow. This is where the power of compound interest comes into play. You earn interest, not just on your initial investment, but also on the interest you've already earned. It's like a snowball rolling down a hill, getting bigger and bigger as it goes. But here's the catch. This process takes time. It requires patience. It requires you to resist the urge to pull your money out at the first sign of trouble, or the first opportunity for a quick win. It requires consistency, sticking with your investment strategy, even when the market is volatile. However, the rewards can be significant. Imagine a tree growing from a seedling to a towering giant. It didn't happen overnight. It took years, even decades. But the result is a sturdy, resilient tree that provides shade, shelter, and maybe even fruit. That's what your investment can become if you practice patience and consistency. In the world of investment, patience and consistency are your best allies.